how to interpret ROCE, return on capital employed. At the outset, please understand what does ROCE tell us. As the name suggests, ROCE, return on capital employed. So what the return on capital employed tells us, what this ratio tells us, this ratio tells us as a business what return the business is earning for the people who have given capital to the business, and that is your return on capital employed. So if I have to put my money into a business, I will always be interested to know as to what kind of return this business is going to generate on the capital. So that is the significance and the purpose that the ROCE serves. Now, how do I figure out whether it is a good ROCE or it is a bad ROCE? Now remember, the fundamental parameter for evaluating ROCE of a business is higher the ROCE, better it is. So as much high as possible is what should be my driver in making investment in any company. So if company that is having highest ROCE, I will always like to put my money into that company. That's number one, fundamental, higher the better. Now, higher the better is fine, but the challenge is the higher has got no upper limit. So therefore, how do I really compare? How do I really benchmark? So for the purpose of benchmarking, what can I do? I can do 3-4 things. Number one, what will I do? Number one, I will compare ROCE of my company with my industry leader or my competitors and check as to how is my return on capital employed in comparison to the return on capital employed of my competitors, my biggest competitor. So if my ROCE is better than my biggest competitor, that means I am doing better. If my ROCE is poor or lower than my competitor, that means there is a lot I need to work in my operations or in my business so as to bring up my ROCE at par or higher than my competitor. So that's number one. Number two, what can I do? I can compare my ROCE of the current year with that of the last year. So if my last year's ROCE was 12% and this year's ROCE is 15%, that means I am doing better in this year than in my last year, which is a good sign. Third thing that I can do is I can compare my ROCE with my budgeted ROCE. So as a company, we always make a business budget at the beginning of the year, and that becomes the roadmap for the following year. So what I can do, I can always compare my ROCE, the actual ROCE, with my budgeted ROCE. So if my actual ROCE is coming 15%, my budgeted ROCE is 14%, that means in my operations, I am doing better than what I had budgeted. And this is how you can do the benchmarking of ROCE, and this is how you can interpret your return on capital employed.